Greetings, Culture Warriors. It is I, Jeff Vieira, the author of Culture is Everything, and your host for this latest dispatch from the front. Well, folks, some more bad news from my old industry in the banking sector here again today, I'm afraid to share with you. This story is from Fortune by Nicholas Comfort. The incredibly shrinking banking sector is heading for near record job losses this year. Job losses at banks this year are on course to be the deepest for half a decade. After a pause during the lockdown, lenders from Citigroup to HSBC Holdings have restarted cuts, taking gross losses announced this year to a combined 63,785 jobs, according to a Bloomberg analysis of filings. That puts the industry on track to exceed almost 80,000 disclosed last year, the biggest retrenchment since 2015. More than 30 lenders from Europe, North America, Asia, and Africa are behind the planned reductions. The actual total is probably higher because many banks eliminate staff without disclosing their plans. The banks cited a need to reduce expenses to offset the cost of credit souring during the pandemic, as well as spending to comply with stricter regulation and invest in digital technology. Total disclosed job elimination since the start of 2014 now stand at about 500,000. For comparison, JP Morgan Chase, the biggest U.S. bank, had a headcount of 256,710 at the end of June. Citigroup said this week it will restart job cuts, joining rivals such as Deutsche Bank AG and HSBC, which resumed staff reductions in May and June. The U.S. bank's reductions will affect less than 1% of its global workforce, which amounted to about 204,000 at the end of the second quarter. Banks headquartered in Europe, which didn't bounce back from the 2008 financial crisis as quickly as the U.S., account for the largest share of the announced job cuts. That's driven largely by HSBC, which said in February that it would reduce its workforce by 35,000 as part of a plan to cut $4.5 billion of costs at underperforming units in the U.S. and Europe. With the pandemic sowing economic uncertainty, it's a tough market for unemployed bankers. There's been a 55% decrease in financial services jobs vacancies in London in July and a 39% fall in August compared to a year earlier, according to data compiled by recruiter Morgan McKinley. Okay, so what's going on here? Well, a couple of things. First off, banks tend to rise with economic activity. So as economic activity goes up, well, people tend to need more money in order to do what they do. And that can be in the form of short-term or overnight loans. That can be longer-term relationships, such as when you take out a loan to buy a car or a home. And so as activity goes up across the economy, well, banks really benefit from that. As economies tip into recession and depression, however, the other side of the equation comes into play. And banks shrink accordingly because fewer people are looking for money. Now, there's a short-term situation where people move money around, just trying to avoid the worst of whatever economic disaster is befalling us. But generally speaking, overall activity is down across the banking sector. Now, combine that with the fact that we've also changed drastically the amount of foot traffic coming into the branches, and you can see why digitization is such a big deal among banks. The branch and teller network is very expensive, so there's always a temptation to cut down on the number of branches you have. Now, the bad thing about that is, as you do that, your presence in the local community likewise drops. So you lose the natural marketing advantage that you gain from having a good presence in different areas. The other thing that may not be realized by folks is that where your bank does not have branches, in order to use ATMs to get your cash, generally they waive the ATM fee, the out-of-network ATM fee. So that costs them money because they're effectively paying their competitors to give you cash. We're also in the midst of a cash crunch driven by the pandemic. And you can bet that the banks will be pushing hard to eliminate cash. The movement of cash is actually a major expense and a major risk for the banks. They would rather have it all be electronic and all be zeros on a screen somewhere. They also get money from the cards. So those debit cards that you see out there, the bank is making money on those because they look like a credit card, work like your checking account, and if you have a boo-boo, they wind up being able to charge you fairly exorbitant fees for overdrafts, and that's worth something to them. They also get kickbacks from the vendors for the payment processing aspect of it. So debit overall is generally seen as a more lucrative endeavor than the ATM channel. So we have an industry that's really going through some serious transition. They also see storm clouds on the horizon because they know that as economic conditions worsen, you start seeing more defaults on loans. You start seeing more repossessions, more foreclosures. It's a natural consequence of that. That is all risk that's going to have to be dealt with by the banks. I mentioned in earlier podcasts how the banks are maintaining reserves far in excess of what the government requires. And that's some of how they will address what's coming. But overall, they're looking at reduced demand. They're looking at having to shift resources from the branches to IT, and those skill sets aren't really transferable. So what they'll do is they'll get rid of the folks at the branch level, and they'll replace them with more expensive coders, and that's how they'll try to make the move through digitization. Now, will that strategy play out in the long term? I don't know. I still think that there is an advantage to community banking for small businesses, for ordinary people. And I think that this retrenchment, which overwhelmingly favors urban areas, which is who the banks like to cater to, is not going to meet the needs of everyone. And so I think that it's going to create an opportunity for people, for people who want to be in the finance industry but are more customer focused, more community based, to do some good things, because you won't have the major banks playing in their sandbox. So you have an opportunity to throw up a branch in the local area, do your work there, and make some hay of it. The big banks aren't going to like that. They're going to want to go back on a mergers and acquisitions binge to buy out competitors. But all they're going to be doing in the process is revisiting the same old history that they had previously. So it'll be interesting to see how this all plays out. It really comes down to, what do you value? Do you value long-term relationships deep with your customers? Or do you value the commoditization of the services that you offer and having that constant race to the bottom in terms of the next largest basis point in interest rate being what's going to determine whether you have customers or not? You know where I stand, but I'm not so sure that the bankers running the big banks are smart enough to see what's coming. We'll know soon enough. Thank you and have a great day.